Hey everyone, and welcome to today's Explainer. If you're studying accounting, finance, or maybe you're an aspiring entrepreneur getting ready to launch your own business, you're in the exact right place. Today, we're unpacking the absolute foundations of how businesses operate, how they create value, and the management accounting tools leaders use to survive in a constantly shifting world. So grab your notes, get settled in, and let's jump right into it.
Okay, here's our roadmap for today. We're covering goals and stakeholders, the two branches of accounting, the decision-making process, the changing business environment, and finally, strategic pricing decisions.
Let's start with Section 1, Goals and Business Stakeholders. Who are we actually doing all this for?
Well, the crucial thing to remember is that a business doesn't just exist in a vacuum. It sits right in the middle of a massive web of people who actually care about what happens to it. We call these folks stakeholders. Basically, a stakeholder is any party who has a vested interest in the organization's economic information and its daily operations.
Now, what's kind of wild is how totally different everyone's needs are depending on where they sit in that web. Think about it. If you're managing the company, you're craving forward-looking data, right? You need estimated costs, selling prices, and profitability forecasts. But if you're a shareholder, your eyes are glued to the overall value of your investment and what kind of income returns you might get. Employees just want the peace of mind that their wages are secure and they have a job tomorrow. Creditors need hard proof you can actually pay back your loans. And the government? Agencies like SARS just want accurate profit data so they know exactly how much to tax you. It's one single business, but with a crazy number of different demands. And honestly, those demands are completely evolving. The goal of a modern business isn't just about lining shareholders' pockets anymore. That's a totally outdated view. Today, successful organizations absolutely have to balance what we call the triple bottom line. Yes, you need economic viability, meaning profit, because long-term value creation is the engine that keeps the lights on. But you also have to protect the planet through sustainable resource use. And you've got to take care of the people, making sure your operations are equitable and fair to your employees and your surrounding community. It's a massive balancing act.
Section 2, Two Branches of Accounting.
So to satisfy all these different people, businesses use two completely different financial compasses. Financial accounting is basically the rigid rulebook for outsiders. It looks at the whole business in the rearview mirror using historical data, usually happens annually, and strictly follows rules like IFRS, so investors can make apples-to-apples comparisons. But management accounting? That's your flexible, future-looking playbook for the internal leaders. It zooms in on specific parts of the business, makes estimates about the future, happens whenever the manager needs it, daily, weekly, whatever, and there are literally no strict external rules. As long as it helps the business win, you can do it.
Moving on to Section 3, the decision-making process. Okay, so how do managers actually use that flexible playbook to steer the ship? They use a really structured loop. Step 1 is the planning process, where you identify your organizational objectives. Essentially, what is the goal? Step 2, you search for alternative courses of action. For example, do we launch a new product or expand into a new city? Step 3, using your management accounting data, you pick the best, most profitable route. And Step 4, you actually implement those decisions, usually by building out a detailed budget.
But hold on, the loop isn't finished without the control process. Implementation is just the start of reality testing. Managers have to constantly compare what actually happened against what they planned in their budgets, because let's be real, things always go off track. When they do, managers use performance reports to respond to those divergencies and pivot. That constant feedback loop is the lifeblood of an agile business.
Section 4, A Changing Business Environment. And staying agile is more critical than ever because the landscape outside the business is literally flipping upside down. Thanks to deregulation and global communication, we've shifted from slow, protected domestic markets to fiercely competitive global arenas. Product life cycles are rapidly shrinking. Just think about how fast last year's smartphone feels completely obsolete. To keep up, traditional manufacturing holding massive inventory has been replaced by just-in-time and lean systems. And we aren't just obsessing over keeping standard costs low anymore. The modern focus is relentlessly on customer orientation and absolute top-tier quality.
Plus, there's the massive impact of technology. Management accountants are dealing with an absolute explosion of digital tools. E-commerce platforms like Checker 6060 have totally blown up market reach while slashing processing costs. Then you have big data, feeding us raw, unstructured insights into human buying behavior. We use artificial intelligence to actually make sense of that data and spot strategic patterns. And the Internet of Things is connecting physical products and manufacturing lines to the Internet in real time. Turning all that raw noise into actionable strategy, that is the modern manager's greatest superpower. But here's the catch.
With all this data and high-stakes global pressure, how do you make sure you don't lose your way? It all comes down to a vital anchor: professional ethics. Organizations mandate strict codes. You absolutely have to maintain integrity, meaning you're straightforward and honest, no matter what. You need objectivity, so you aren't letting biases or conflicts of interest cloud your business judgment. And you need professional competence, constantly keeping your skills sharp. These aren't just nice-to-have buzzwords, they're the absolute bedrock of trust in management accounting.
Section 5. Strategic pricing decisions. Let's bring all this macro strategy down to a very practical micro level. How do you actually set the price for your product? Well, the most traditional way you'll encounter is cost plus pricing. It's exactly what it sounds like. You figure out exactly what the product costs the company to manufacture, and you simply slap a desired profit margin, or markup, right on top of it.
It sounds super easy, right? And it is. It's incredibly quick to compute, which is a lifesaver if you have thousands of products. Plus, it feels morally defensible to regulators since you're just making a fair return on your costs. But here is the massive, glaring downside. It completely ignores what the customer is actually willing to pay. If your costs are high, your price ends up being high, and you might literally price yourself right out of the market and lose sales. That's why in the real world, managers almost always have to manually tweak these prices based on market reality.
Now, imagine you're an entrepreneur bringing a totally revolutionary, innovative product to market with no close substitutes. In that case, you might use a strategy called price skimming. This is where you set a really high initial price to cash in on the novelty factor, and then you gradually lower it or skim it down as the initial hype wanes and competitors start showing up.
This is a brilliant strategy for recovering your upfront research and development investments super quickly. It also gives you a nice buffer just in case your future manufacturing costs unexpectedly spike. But you really have to weigh the risks. If you aren't careful, you can totally alienate your broader, highly price-sensitive customer base, who might just write off your brand as greedy or inaccessible.
And then, on the absolute opposite end of the spectrum, we have penetration pricing. This is where you charge a dramatically low price right out of the gate. The goal isn't immediate profit. The goal is rapid market acceptance and aggressively capturing market share.
By charging almost nothing at first, you basically flood the market. It's a fantastic way to build customer habits quickly and severely discourage new competitors from even trying to enter the space, because the profit margins just look absolutely terrible to them. But the catch is brutal. It diminishes the perceived value of your product. Once people are used to paying a rock-bottom price, it is extraordinarily difficult to raise prices later without causing a massive backlash. Plus, your business needs some serious financial backing to survive those initial early losses.
So, what does this all mean for you? When you step into a management role or launch your very own startup, which pricing strategy are you going to deploy? Will you skim the top of the market, aggressively penetrate it, or play it safe with cost plus? And perhaps the most important question of all, how will you use your management accounting data to prove to your stakeholders that you made the right call? Remember, behind every single successful business decision, from pricing a product to balancing the triple bottom line, is a well-crafted, data-driven management accounting strategy. Thanks so much for joining me on this explainer. Keep analyzing, keep questioning, and I'll catch you in the next one.